welcome once again to Intelligent Investment Today. This is the podcast where we explore the timeless principles of value investing, taking the wisdom of Benjamin Graham, Warren Buffett, and the other great investors, and applying it to the challenges faced by investors today. Today, we're going to look at a curious paradox right at the heart of investing. Almost everybody wants and expects above average investment returns. But remarkably few people are willing to think differently from the average investor. Instead, they look for reassurance. They seek confirmation. They find comfort in agreement. If everyone else is buying, they feel happier buying. If everybody else is selling, they feel safer selling. And yet, there is one rather awkward problem. If you simply copy what everyone else is doing, then at best you should expect average results. And after fees, commissions and taxes, probably a little worse than average. Today's episode is about one of the defining characteristics of every great investor. Not intelligence, not mathematical brilliance, not predicting the future, but independence of thought. The ability to reach your own conclusions, to remain calm when everyone around you appears convinced you're wrong. Because Graham once wrote something that every investor should have framed on their wall. You are neither right nor wrong because the crowd agrees or disagrees with you. You are right because your data and your reasoning are right. Those few words may just contain one of the greatest lessons ever written about investing. So let's get right down to it. As ever, settle in, ignore the latest market noise for at least the next 20 minutes, and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. Imagine asking 1,000 people what 2 plus 2 equals. Suppose every single one of them confidently replied 5. Would that somehow alter mathematics? Of course not. Reality is wonderfully indifferent to opinion. It doesn't matter how many people believe something. Truth is not decided by majority vote. Yet somehow, when money becomes involved, we forget this remarkably quickly. If 1 million investors decide a company is worth $100 billion, it somehow feels more believable than if only one investor thinks so. But intrinsic value doesn't emerge from consensus. It emerges from facts. A business earns what it earns. It owns what it owns. Its debts remain exactly the same, regardless of how many enthusiastic commentators appear on the television. Markets can influence price, but they cannot alter value. Graham understood this perhaps better than anyone. His famous character, Mr. Market, is often remembered because he offers irrational prices. But perhaps the more important lesson is this. Mr. Market is usually accompanied by millions of other people who happily agree with him. When markets become euphoric, almost everybody becomes optimistic. When markets panic, almost everybody becomes pessimistic. The herd moves together. It always has. It always will, because there is tremendous comfort in agreement. If everybody loses money together, somehow it feels less painful. Being wrong collectively appears preferable to being right alone, which is rather odd when you stop and think about it. Human beings evolved as social creatures. For thousands of years, separating yourself from the tribe was genuinely dangerous. Agreement improved survival. Standing apart often did not. Unfortunately, our brains still carry much of that programming into modern financial markets. When everyone else around us buys tech shares, we feel uneasy not owning them. When everyone predicts a market crash, we suddenly begin imagining one ourselves. When newspapers declare that this time it's different, our natural instinct is to wonder whether perhaps it really is. The herd offers emotional comfort. Markets, however, rarely reward the same. Warren Buffett once observed that you don't have to be smarter than everyone else. You simply have to be more disciplined. And part of that discipline is becoming comfortable with temporary disagreement. Because if your analysis is sound, other people's opinions are largely irrelevant. Imagine buying a house. You carefully inspect it, survey it, assess its condition, compare similar properties, and negotiate a sensible price. The day after completion, your neighbour knocks on the door and announces, "I think you've overpaid." Would you immediately sell the house? Of course not. You'd probably offer them a cup of tea, politely thank them for their opinion, and carry on unpacking. Yet investors routinely allow complete strangers to alter their conviction in businesses they've supposedly researched for months. It's actually rather curious. One of the greatest dangers of herd thinking is that it disguises laziness. If everyone else believes something, we feel less need to investigate it ourselves. After all, surely millions of investors can't all be wrong. Well, history suggests they can. The South Sea bubble, the railway mania, the Nifty 50, the dot-com boom, the housing bubble, the meme stock frenzy. Each generation convinces itself that collective enthusiasm somehow validates valuation. But it never does. Popularity and value are entirely different concepts. McDonald's is popular, but that doesn't automatically mean its shares are cheap. Likewise, an unpopular company isn't necessarily expensive. Markets constantly confuse popularity with value. The intelligent investor must not. There is another important point. Independent thinking does not mean automatically disagreeing with everybody. Some people mistake contrarianism for intelligence. If everyone buys, they sell. If everyone sells, they buy. Simply for the sake of appearing different. This isn't independent thought. That is just herd behaviour wearing a fake moustache. True independence means reaching your own conclusion before discovering whether the crowd agrees. Sometimes you'll agree with everyone else, sometimes you won't. Neither outcome matters, only the quality of your reasoning does. This is why Graham's quotation is so profound. You are neither right nor wrong because the crowd agrees or disagrees with you. Think carefully about those words. Agreement proves nothing. Disagreement proves nothing. Facts prove everything. If your analysis is poor, you'll eventually be wrong, even if everyone initially applauds you. If your analysis is excellent, you'll eventually be right, even if everyone initially laughs. Markets have a wonderful habit of correcting misplaced confidence, eventually. Independent thinking also requires intellectual humility. Notice I didn't say stubbornness. Those are very different things. The independent investor continually looks for evidence that contradicts their own conclusions. Not because they enjoy proving themselves wrong, but because they understand that they might be. There's a wonderful difference between changing your opinion because the facts have changed, and changing your opinion because Twitter becomes excited. Professional investors often struggle with independent thought more than private investors, which sounds surprising until you consider their incentives. Imagine that you're a fund manager. Would you rather underperform alongside everybody else, or underperform completely alone? Career risk often encourages conformity. If everyone buys the fashionable technology company and it collapses, at least everyone made the same mistake. If you avoid it while everyone else buys and it doubles, clients start asking uncomfortable questions. So, ironically, the safest career decision isn't always the best investment decision. And for this reason, private investors actually possess an extraordinary advantage. They don't have to explain themselves every quarter. They don't have clients demanding daily updates. They can simply think, read, wait, and act only when evidence supports doing so. It is an enormous competitive advantage, yet many voluntarily surrender it by behaving exactly like institutional investors, watching the same headlines, following the same trends, reacting to the same emotions. Yet why would anyone want to copy professionals when so many professionals struggle to beat the market? One of the most liberating moments in investing comes when you stop caring whether your decisions are fashionable. You stop asking, what is everyone buying? And instead ask, what is this business actually worth? And those are very different questions. Only one leads naturally to value investing. Perhaps independence of thought is really another way of describing confidence in your own process. Not confidence that you will always be right. Nobody is. But confidence that you've done the work, read the reports, studied the accounts, considered the risks, and demanded a margin of safety. If, after all that, someone disagrees with you, so be it. They may be right, you may be right, time will decide, not popularity. As we start to close out this discussion, perhaps the greatest irony in investing is this. Everybody wants exceptional results, yet exceptional results almost always require exceptional behaviour. Not extraordinary intelligence, not secret information, simply the willingness to think independently when everyone else prefers the comfort of agreement. Graham understood that. Buffett understands it. Every truly successful value investor has understood it, because markets are voting machines in the short term, but weighing machines in the long term. Votes are counted, weight is measured, and the weighing machine has never cared what the crowd thought. And on that note, we bring this episode of Intelligent Investment Today to a close. I hope you've enjoyed this exploration of independent thinking and why one of the greatest assets any investor can possess isn't a faster computer or a more complicated spreadsheet. It's the confidence to reach your own conclusions and the discipline to follow them. Because in investing, as in life, agreement is not evidence, popularity is not proof, and truth has never been decided by a show of hands. Please do subscribe or add to playlist so that you need never miss a future edition. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.